Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Tyler Crow, buddy, it is time for us to go bargain hunting in energy. Specifically, we're going to look at renewable energy. You and I love Brookfield Renewable. It's a great business. It has done both of us so well as investors. One that I definitely will continue to own. But man, it is not cheap right now. I'm Jason Hall. I should say that. I know you, Tyler Crow, have a stock, a renewable energy stock that you think is probably bargain hunting territory right now. What you got for us?
You used my two favorite phrases, I guess. Bargain hunting and energy stocks. It warms my heart that we get to discuss this.
Which
All
one
right,
have you got for
so
us?
I'm going to make the case for in what is an industry that is pretty devoid of bargains right now. There ain't much. It's slim pickings, but I think I found one, and I'm going to make the case for Canadian Solar. So for those of you who are not familiar, Canadian Solar is not actually a Canadian company. They're technically Chinese. They are a solar panel manufacturer. And
Tyler, I'm going to stop you right here. It's a solar panel manufacturer, an area that has been a terrible investment, partly because China ruined it for everybody by subsidizing the industry, driving up all of the
I
production.
know all of this. I know this, and I'm
Okay,
still
so
saying
all right,
this.
all right. So I'm just saying, yeah, I've got a pretty high bar here. Canadian Solar. So make the case.
Sure. Solar panel manufacturer also has a development business, also has a battery storage business. At one time was a little bit levered up, a little bit extra debt that you wouldn't like to see. And that development business was very lumpy. You could go like 2 years where earnings would look like garbage, and then they'd have 1 year where it's like we just produced earnings for 5 years in 1 year because of the way these development schedules worked. But their panel manufacturing business has grown so much that the development business has more or less become insignificant. In 2022, somewhere between 10 and 15% of total revenue. The panel manufacturing business has become profitable, somewhere around 17, 18% operating margins, which is pretty good. But what is interesting to me is I really feel like there's a little bit of a misunderstanding of its balance sheet right now. It has a couple of development projects on the books, and as a result, it has to keep cash on the books, restricted cash. And if you combine its current cash and restricted cash, it's $2 billion just sitting on the balance sheet. This has a $2.2 billion market cap with marginal and manageable debt. So when I look at that, it suggests to me that trading at book value with that much of its book in just cash says that you're not paying an awful lot for the manufacturing business, even
You
if
either get the cash for a heavy discount or you get the operations for a heavy discount, either way you look at it.
that's the case. It's not the perfect stock, but we're looking for bargains, and bargains sometimes mean you're buying something for a mispriced asset and then just selling it later. And that's what I think Canadian Solar might be right now.
Tyler, I want to talk about a peer to Brookfield Renewable. So again, the short version of Brookfield Renewable's business is they finance, acquire, and operate renewable energy power production facilities, good ways to generate long, steady flows of cash, pay a good dividend, grow those dividends over time. But like I said, it's expensive. This is a stock that trades for close to 17 times enterprise value to EBITDA. So that's a really expensive 17 times. One that I own a little bit of and I think is really interesting right now is Atlantica Sustainable Infrastructure. The ticker is AY. This is a much, much smaller company. So there's a couple things they're doing that I really like. They have a small amount of natural gas assets, but they're really laser focusing in on wind and solar and also the transmission assets that connect those wind and solar assets to the grid. You look at what you're getting today and you're paying roughly 10 times EV to EBITDA, which is not hyper cheap, but definitely cheaper and on the more reasonable end of the valuation for these kinds of businesses. You're also getting a 7.5% dividend yield. So they just modestly increased their dividend. They're looking to be able to grow it over time as they grow those cash flows. So you get a really good yield, paying a reasonable price. Here's the caveat. It's smaller. It's a little more concentrated in terms of their customer mix. They also have a pretty high amount of debt leverage. It trades for right around 1.6 times debt to equity. So you're buying it cheaper, but with a little bit more leverage. And in this interest rate environment that we're in, where rates are going to go up, there could be some impact on their cash flows and their ability to acquire other assets going forward. So I think you really have to focus on management's ability to navigate that environment if they can navigate it really well, you're going to get rewarded for paying this lower price. But again, remember, you're paying this lower price because the market does see some risk because of interest rates that are higher, and they do have a little bit of higher leverage. Just be aware, but I think this could prove to be a real bargain.